Imagine this. You wake up one morning and everything seems normal. The sun is shining, birds are chirping, and you go about your usual routine. But then you hear the news. The US government has slapped a hefty tariff on gold and silver. What happens next? How does this affect you, your investments, and the broader economy? This isn't some wild hypothetical scenario. It's a real possibility that could have far-reaching implications. It's a question worth pondering, especially given the current economic climate. With inflation on the rise and global markets in flux, the idea of a tariff on precious metals isn't as far-fetched as it might seem. We've seen governments pull these levers before, often with unintended consequences. History is replete with examples of well-intentioned policies that went awry. The US gold market, known for its liquidity and efficiency, could be turned on its head. Picture the ripple effects. Prices could skyrocket and market dynamics could shift dramatically. Dealers, investors, everyone scrambling to adjust. The uncertainty alone could cause panic, leading to a sell-off or a buying frenzy, depending on market sentiment. We're talking about a seismic shift in how gold and silver flow through the global financial system. The impact wouldn't be confined to the US alone. It would reverberate across international markets. Think back to what happened in India when they imposed those tariffs on gold imports. The black market exploded. Smuggling became rampant and the official channels were undermined. Remember when they imposed those tariffs on gold imports? The black market exploded. Smuggling became rampant. The government's attempt to control the flow of gold backfired spectacularly. Instead of curbing demand, it simply pushed the trade underground, making it harder to regulate and control. And let's not forget about Vietnam. Their experience with gold import restrictions wasn't pretty either. The market became chaotic and the black market thrived. People found ways around the restrictions, often resorting to illegal means. It just goes to show that tampering with a free market, especially one as globally intertwined as gold, rarely goes according to plan. The consequences can be far-reaching and often counterproductive, leading to more problems than solutions. The US gold market. It's a well-oiled machine, a complex yet efficient system that has been honed over decades. A testament to free market efficiency, where every transaction is a piece of a larger puzzle. Buyers and sellers, large and small, converge to determine the price of gold. This dynamic environment is driven by real-time data and rapid decision-making. It's a global benchmark, a reflection of supply and demand in its purest form. The US gold market influences and is influenced by markets around the world. Liquidity is the name of the game. The ease with which gold can be bought and sold is unparalleled. Want to buy gold? No problem. The market is always ready to accommodate new buyers. There's always a seller ready to make a deal. The market's depth ensures that transactions can happen smoothly. Need to sell? Just as easy. The market's liquidity ensures that sellers can find buyers without much hassle. This constant flow of transactions ensures a fair and transparent market. Prices are determined by the collective actions of all participants. That's why the US gold market is so crucial. It acts as a barometer for economic health and stability. It provides a stable platform for investors and businesses worldwide. The reliability of the US gold market attracts global interest, but slap a tariff on it, and you risk throwing a wrench into the gears. Such disruptions can have far-reaching consequences, affecting not just the US, but the global economy. Let's talk about India. They tried to control gold imports with tariffs. What happened? A surge in smuggling, for one. People found ways to get around the system. It's basic economics. When you artificially inflate prices, you incentivize illegal activity. And then there's Vietnam. They imposed restrictions on gold imports. The result? A thriving black market. The official channels were stifled, so people turned to alternative sources. The government's attempt to manage the gold market backfired. These examples highlight a crucial point. Tariffs often have unintended consequences. They distort markets, create inefficiencies, and can even fuel illegal activities. The US should heed these cautionary tales. Now let's talk about the US futures markets. These markets are a cornerstone of the global financial system, playing a crucial role in the trading of commodities, financial instruments, and other assets. They are not just a place for speculation, but serve as a vital mechanism for price discovery and risk management. This is where things get interesting. The U.S. futures markets are dynamic and complex, involving a wide range of participants from individual traders to large institutional investors. These markets are the lifeblood of global commodities trading. They facilitate the buying and selling of everything from agricultural products to energy resources, metals, and financial instruments. They provide transparency, liquidity, and a platform for price discovery. This means that prices are determined in a fair and open manner, reflecting the true supply and demand dynamics of the market. But introduce tariffs on gold and silver and you risk disrupting this delicate ecosystem. Tariffs can distort market prices, leading to inefficiencies and reduced market confidence. Hedgers, speculators, and arbitrageurs rely on these markets to manage risk and capitalize on price movements. Hedgers use futures to protect against price changes, while speculators seek to profit from market fluctuations. Tariffs could lead to increased volatility, wider bid-ask spreads, and reduced trading volume. This increased uncertainty can make it more difficult for market participants to execute trades efficiently. This could spill over into other markets, creating uncertainty and fear among investors. The interconnected nature of global markets means that disruptions in one area can have far-reaching effects. The bottom line: tampering with U.S. futures markets is a risky proposition. The potential for unintended consequences is enormous, and the fallout could be felt far beyond the gold and silver markets. The potential for unintended consequences is enormous, and the fallout could be felt far beyond the gold and silver markets. Policymakers and market participants must tread carefully to avoid triggering a cascade of negative effects that could destabilize the broader financial system. Gold prices, not skyrocketing, but volatile. Let's clear up a common misconception. Will tariffs make gold prices skyrocket? Not necessarily. Gold prices are determined by global supply and demand, not just U.S. policies. However, tariffs could inject a significant dose of volatility into the market. Remember those unintended consequences we talked about? Price swings could become more frequent and pronounced. This volatility stems from uncertainty. When you introduce artificial barriers like tariffs, you create an environment ripe for speculation and fear-driven trading. So while tariffs might not send gold prices to the moon, they could certainly make the ride a lot bumpier. Strange signals. What's happening in the market? Let's delve into some unusual market behavior we're seeing. Gold lease rates, for instance, have gone through the roof. This signals a potential shortage of physical gold, a sign that something is amiss. Now this could be due to various factors, but it's certainly something to keep an eye on. When the cost of borrowing gold spikes, it suggests that supply is struggling to keep up with demand. This unusual market activity underscores the importance of understanding the fundamentals. Something is driving these lease rates higher, and it's crucial to separate noise from meaningful signals. The gold standard myth. Let's address the elephant in the room, the gold standard. Some folks believe that tariffs are a precursor to the U.S. returning to a gold-backed currency. Let's be clear, that's highly unlikely. The gold standard has its proponents, but it's a relic of the past for a reason. The U.S. economy is far too complex and dynamic to be shackled to a fixed gold price. It would be like trying to fit a square peg into a round hole. So, while the gold standard debate might resurface from time to time, it's crucial to separate wishful thinking from economic reality. Navigating the golden future. As we navigate the choppy waters of the global economy, one thing is clear: uncertainty reigns supreme. The threat of tariffs, the unusual market behavior, it all points to a need for prudence and vigilance. Understanding the fundamentals of the gold market has never been more critical. Don't get caught up in the hype or fear-mongering. Do your research, seek out credible sources, and make informed decisions. The future of gold, like the global economy itself, is uncertain. But by staying informed and focusing on the fundamentals, you can position yourself to weather the storms and capitalize on the opportunities that lie ahead.